Hello everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to take you through a problem and its related solution from the topic cost volume profit analysis. This problem is specifically related with the product elimination decision. So based on the calculations done in the problem, the management of a company could decide whether to eliminate a product or to continue with the product. These are all a couple of details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Let's get into the problem. A company manufactures 3 products and their respective details are furnished below. The products are named X, Y, Z. Capacity engaged. For X, it is 20% of production capacity utilized. For Y, it is 40%. For Z, it is 40%. This is how the production capacity is utilized for manufacturing the given 3 products. Units produced of X 2000, Y 5000, Z 6000 units. Then regarding the cost breakup per unit, material 20 rupees per unit of X, 32 rupees for Y, 36 rupees for Z. Wages 10 rupees for X, 12 rupees for Y, 16 rupees for Z. Variable overheads 7 rupees, 9 rupees and 11 rupees respectively. Similarly, fixed overheads 20 rupees, 19 rupees and 20 rupees respectively for X, Y and Z products. The total cost per unit of X comes to 57, Y comes to 72 and Z comes to 83. Regarding selling price per unit, it is 55 rupees per unit of X. Therefore, the concern incurs a loss of 2 rupees per unit of X. Regarding Y, it is 75 rupees selling price. Therefore, the concern earns a profit of 3 rupees per unit through sale of Y. Then regarding Z, the selling price is 85 rupees per unit. Therefore, profit of 2 rupees. So regarding Y, it earns a profit of 3 rupees per unit, and regarding Z, it earns a profit of 2 rupees per unit. The management proposes to discontinue line X. Looking at the cost breakup and the revenue details of the products, since X is giving 2 rupees loss per unit, the management has proposed to discontinue the line of product named X. It is intended to utilize the disengaged capacity in the lines of product Y and product Z equally. So after discontinuing product X, the company wants to utilize its capacity for manufacturing Y and Z equally. This is a decision they have taken, they have proposed to take. Now you as a management accountant are advised to give suitable advices to the management. Now let's do the calculation. Statement showing comparative profitability of products X, Y and Z. Now you find there are 2 columns for each product. One is for per unit and the other one is for total. That is how it is structurized. And the last one is the grand total column in the table. Now sales 55 rupees per unit of X. So total sales comes to 2000 into 55, 1,10,000. And similarly for Y, 75 rupees is the selling price per unit. 75 into 5000 units, it comes to 3,75,000. For Z, it is 85 rupees per unit. Into 6000 units, it comes to 5,10,000 rupees, the total sales from Z. And the total sales of all the 3 products comes to 9,95,000. Then regarding material, wages, variable overheads that are presented as that are given in the problem. And the per unit material cost, wages cost and variable overheads are multiplied with the corresponding number of products X, Y and Z. See, for example, 20 rupees of material cost per unit of X into 2000, it comes to 40,000. And similarly for Y, it is 32 rupees material cost per unit into 5,000. It comes to 1,60,000. Similarly for Z, it is 36 rupees material cost per unit into 6,000 units, it comes to 2,16,000. So total material cost for all the 3 products comes to 4,16,000. Similar working is done for wages and variable overheads also. Now total variable cost given with the character of B, whereas sales is given with the character of A. Total variable cost for X, it comes to 37 rupees per unit. In total, it comes to 74,000 rupees. Then for Y, 53 rupees is a variable cost per unit. In total, the variable cost comes to 2,65,000 rupees for Y. Then regarding Z, it is 63 rupees variable cost per unit. In total, it comes to 3,78,000 rupees. The grand total of variable cost comes to 7,17,000. Now from the sales character A, if you subtract the variable cost character B for both the per unit column and the total column of all the three products, you get the contribution margin both for one unit as well as in total. Now for X, 55 rupees selling price minus variable cost per unit 37, it gives 18 rupees contribution. The similar working is done for total amount also. 1,10,000 total sales of X minus variable cost in total 74,000, it gives the balance as contribution of 36,000. The similar working is done for product Y and Z as well. So we get 20 rupees contribution margin per unit of Y. In total, it comes to 1,10,000 rupees for the same product. Then regarding the third product Z, it comes to 22 rupees as contribution margin per unit of Z. In total, it comes to 1,32,000 rupees. The grand total of contribution from all the three products comes to 2,78,000. From the contribution, if you subtract the fixed cost, you can get profit. The fixed cost comes in total of 2,55,000. How it is calculated? Look at the working down here. When the factory manufactures 2,000 units of X, it is 20 rupees of fixed cost per unit. Therefore, multiply these two, you get the total fixed cost incurred for manufacturing 2,000 units of X. It comes to 40,000. Similarly, when the factory produced 5,000 units, it is 19 rupees fixed cost per unit. If you multiply both, you get the total of 95,000 rupees fixed cost in relation to product Y. Then similarly for Z, when the factory produces 6,000 units, it is 20 rupees fixed cost per unit. Therefore, 6,000 into 20, it comes to 1,20,000 rupees. That's a fixed cost allocated to product Z. If you total all the three, you get the grand total of fixed cost, that is amounted 2,55,000, which is subtracted here from the grand total of contribution amounted 2,78,000. The balance comes as 23,000, which is nothing but profit earned by the business concern through manufacturing and selling the three products named X, Y and Z. Now let's calculate the profit volume ratio. Why should we calculate the profit volume ratio? Profit volume ratio is the best indicator to decide which product is more profitable. This is what you need to understand always. Now, contribution divided by selling price into 100. Contribution per unit is 18 rupees for X and divided by selling price 55 into 100, it gives us 32.73% as PVR. For Y, 22 rupees contribution divided by 75 rupees into 100, it gives us 29.33% as PVR. Then for Z, it is 22 rupees contribution divided by 85 rupees sales into 100, it gives us 25.88% of PVR. If you look at the PVR of the three products, I am sure you find the PVR of product X is much higher than that of other two products. Then is it advisable to discontinue the product since it is incurring loss temporarily as 2 rupees per unit? No, it is not really advisable to discontinue product X. Perhaps the company should take adequate efforts to increase the sales of product X, then only it can earn the maximum profit. So product X is found to be more profitable than other two products. It's because it is associated with a higher PV ratio comparing the other two products named Y and Z. That's what the conclusion given here through the 3 points. Point number 1. Product X is most profitable of the three products because of its higher PVR. Number 2, loss per unit of 2 rupees shown for X is mainly due to the fixed overhead apportion. So X should not be discontinued. Its sale should be improved if possible. This is what the real conclusion behind this situation Therefore, you as a management accountant advise the management not to discontinue product X. Thanks for watching this video. I hope I have done my explanation up to your level of satisfaction. I'll meet you in another video. Bye for now, everyone.